In this unit, we cover the accounting and reporting for nonprofit organizations. The objectives are: 1. Define the nonprofit organization. 2. Understand the unrestricted, temporarily restricted, and restricted net asset concept of accounting. 3. Understand revenue accounting peculiar to nonprofit organizations. 4. Understand the nonprofit accounting for contributed material, services, and facilities. 5. Understand the nonprofit accounting for pledges. 6. Understand a few other accounting rules peculiar to nonprofit organizations. And 7. Describe and prepare a nonprofit organization's financial statements to include the statement of financial position and the statement of activities. In most communities, there are many nonprofit organizations, to include colleges, universities, museums, churches, hospitals, performing arts, and social service agencies such as United Way, Red Cross, Salvation Army, and many others, large and small. Not-for-profits are operated to benefit society rather than benefit the owners, the stockholders. Several critical differences between nonprofits and for-profit businesses can be identified, such as: 1. Many private not-for-profit organizations receive a significant amount of their financial resources from contributions rather than from revenues or capital investment. 2. Some of the resources given to a not-for-profit organization include donor-imposed restrictions. And 3, no single indicator of success is present, such as net income. Similarities to a business include being governed by a board of directors, expenses allocated to specific accounting periods, like the use of depreciation, and the use of accrual accounting. Similarities to a government entity include the fact that they both serve society and have no objective to earn a profit. Both are financed by citizens, donations for the nonprofit, and taxes for the government entity. A basic concept in the nonprofit world is the net asset. Assets equals liabilities plus net assets. Therefore, assets minus liabilities equals net assets. Instead of showing retained earnings or owner's equity, the nonprofit financial statement shows net assets. Effective for fiscal years beginning after December 15th, 2017, the FASB has issued new rules to simplify the treatment of net assets in the nonprofit financial statements. Net assets will now be classified as net assets with donor restrictions and net assets without donor restrictions. Previously, 3 net asset classifications were used: unrestricted, temporarily restricted, and permanently restricted. When a nonprofit receives funds to be spent on a certain program only, or in the future, or kept in perpetuity, they are recorded in the assets with donor restrictions category. In perpetuity means the nonprofit can use only the income from the restricted net asset, not the principal. When accountants close the books of nonprofits at the end of a period, there is no retained earnings account. Instead, the increase or decrease in net assets is closed to the category for which it belongs to. I'd like to show you an example for a nonprofit. We start with assets of $100,000. Liabilities are $80,000. Assets without restrictions are $15,000, and the net assets with the restrictions are $5,000. We have donations of $20,000 and expenses of $15,000, all paid by cash. We transfer $2,000 from the restricted net assets to the unrestricted. At the end of the year, we will close out the donation and the expense accounts to the unrestricted net assets. The transfer accounts will be closed to their respective net asset accounts. Assets are now $105,000. The $100,000 plus the $20,000 minus the $15,000. Liabilities stay at $80,000. Net unrestricted net assets have increased to $22,000. Restricted net assets have decreased to $3,000. On the nonprofit financial statement, instead of having net income of $5,000, we show it as an increase to unrestricted net assets of $7,000 and a decrease to restricted net assets of $2,000. The nonprofit balance sheet is called the Statement of Financial Position. Note that we are required to show the net assets in the two classifications: net assets without donor restrictions and net assets with donor restrictions. The nonprofit income statement is called the Statement of Activities. We show the transfer between the net assets without donor restrictions and the net assets with donor restrictions. We also show the beginning net assets, the increase or decrease in the ending net assets. For the Statement of Activities, we must show the individual net asset classifications and the total. Recording revenue in a nonprofit such as a hospital can get complicated because of the copays, Medicare, Medicaid, and health insurance, and most likely a combination thereof paying the bill. You need to be sure that the amount you are billing, the accounts receivable, is the amount that you expect to receive. Healthcare organizations exhibit some unique reporting features that must be addressed in not-for-profit accounting. Third-party payers, such as Medicare and insurance companies, have had a significant impact on the reporting process because of their need for usable financial information. A net patient service revenue figure is actually reported by these organizations, but only after reduction for contractual adjustments. These adjustments are decreases allowed for some third-party payers based on the approved costs for a particular service in that geographic region. Recording patient charges can be complicated at a hospital. Some of the amount is due from the patient and another portion from the third-party payers such as Medicare and the insurance companies. And the hospital may have $800,000 of charges, of which $700,000 is billed to third-party payers, $80,000 is billed to patients, and $20,000 was services to the poor that is considered charity and will not be collected from any source. In addition, it is felt that 10% of the amount billed to patients will not be collected. Here is the journal entry to record this transaction. Accounts receivable, third parties, will be debited for $700,000. Accounts receivable patients will be debited for $80,000. Patient service revenue will be credited for $780,000. The $20,000 service to the poor will not be recorded as either revenue or a receivable, as it was performed with no expectation of being paid. You could record this amount as a $20,000 debit to receivable and credit to revenue, and then immediately reverse the entry or not record it at all, which is what most hospitals do. Amounts are posted to the ledger. The expected bad debt of $8,000, 10% of $80,000, is recorded in the same way as a for-profit business, with a debit to bad debt expense and a credit of $8,000 to the allowance for uncollectible accounts. Amounts are posted to the ledger. Recording revenue in a hospital can get further complicated because of the copays, Medicare, Medicaid, and health insurance, and most likely a combination thereof, paying the bill. You need to be sure that the amount you are billing, accounts receivable, is the amount that you expect to receive. Patient service revenue figures are reported by these organizations only after a reduction for contractual adjustments. These adjustments are decreases allowed for some third-party payers based on the approved cost for a particular service in that geographic region. Here's an example. You are charged $300 for a blood test, but Blue Cross may only pay $280. If the hospital is not going to bill the patient for the difference, they would use an allowance account. Accounts receivable from Blue Cross would be debited for $280. The contractual adjustment account would be debited for $20. Blood test revenue is credited for $300. Amounts are posted to the ledger. The financial statement will show revenue net of $280. Generally accepted accounting principles calls for contributions to be recognized as revenue when received. Restricted contributions are recognized as revenue either within temporarily restricted net assets or permanently restricted net assets. Donated assets are recorded at fair market value. Recognition of the donation of artworks, historical treasures, and the like is not required if the items are added to a collection for public exhibition, education, or research, and the items are protected and preserved. If sold, receipts must be used to acquire other collection items. Services contributed to a not-for-profit organization should be recognized as a revenue if the service creates or enhances a non-financial asset or requires a specialized skill possessed by the donor and would be purchased if not donated. Contributed services are recorded with a debit to expense and a credit to contributions revenue if the service is one that requires specialized skills like a carpenter, lawyer, or accountant. For example, if you provide free accounting services to a nonprofit that normally would cost $5,000, the journal entry would be a debit of $5,000 to accounting expense and a credit of $5,000 to contribution revenue. The amounts are posted to the ledger. If inventory is contributed, the inventory should be recorded at its fair market value. If you contribute food to a food bank that has a book value on your books of $4,000 and a market value of $8,000, the food bank would show a debit to food inventory of $8,000 and a credit of $8,000 to contribution revenue. The amounts are posted to the ledger. A promise to give, pledge, is a written or oral agreement to contribute cash or other assets to the nonprofit. There should be sufficient evidence in the form of verifiable documentation that a promise was made and received. Unconditional promises to give that are expected to be collected or paid in less than 1 year may be measured at net realizable value, the net settlement value, which results in a reasonable estimate of fair value. Those to be received in more than 1 year should be recorded at the present value of the estimated future cash flows. The basic rule is that the pledge receivable on the balance sheet should show the amount of money that the nonprofit can reasonably expect to receive in the future from the pledge. Unconditional pledges should be recognized in the year they are received, even if the actual contribution will be received in installments over future accounting periods. A multi-year gift pledge should be recorded at the net present value of the gift. The journal entry to record an $8,000 pledge would be a debit to pledge receivable and a credit to contribution revenue. The amounts are posted to the ledger. An allowance for doubtful pledges should be set up similar to that used for retail accounts receivable. If we are estimating 5% of the pledges would become uncollectible, we would debit uncollectible pledge expense and credit allowance for uncollectible pledges for $400. Amounts are posted to the ledger.
The statements of a nonprofit organization include a statement of financial position, a statement of activities, and a statement of cash flows. Let's first look at the statement of financial position. The statement of financial position is like the balance sheet that you are used to. Here is an example. The statement of financial position reports the organization's assets,
liabilities, and net assets. Assets minus liabilities equals net assets. The statement of financial position reports net assets in the two classifications: net assets without donor restrictions and net assets with donor restrictions. We are required to show only net assets in these two categories. Assets and liabilities are combined. Unrestricted net assets indicates the amount of an entity's resources that are not subject to external donor restrictions. Officials of the organization can make whatever use they wish of these assets. Net assets with donor restrictions are restricted by an outside party for a particular use or for use in a future period of time. When the restriction is satisfied, these resources are switched to net assets without donor restrictions. Thus, on the statement of activities and changes in net assets, these net assets with donor restrictions are shown as being reclassified to the net assets without donor restrictions when the appropriate time has passed or the resource is used as stipulated. Net assets with donor restrictions may be permanently restricted. Permanently restricted net assets are expected to remain restricted for as long as the organization exists. Income from these assets is normally unrestricted based on the specifications of the donor. The statement of activities is a combination income statement and statement of retained earnings. Nonprofit organizations have no net income. What they show is the change in net assets. The statement of cash flows is very similar to that used for business. Here is an example. As you can see, the statement of activities reports the amount of change in the net assets for the period with a caption such as changes in net assets. In essence, this is the nonprofit's net income. The statement of activities reports the amount of change in each of the two classifications of net assets: net assets without donor restrictions and net assets with donor restrictions. It is very important that everything balances. The statement of activities reports the gross amount of revenues and expenses, with the exception of investment revenue, which may be reported net of expenses and gains and losses on the disposal of plant assets that may be reported net. The statement of activities, or a note thereto, reports expenses by functional classification, such as program and administrative, which is supporting. Normally, this is a separate schedule. What this means is that you must show the breakdown of expenses between program and administration. Let's say the local Salvation Army post runs a soup kitchen, a daycare, and a homeless shelter. In their financial statements, they would more than likely have a separate schedule, which is shown as a footnote to the financial statements, that shows expense broken down into soup kitchen, daycare, homeless shelter, and administration. The total of these four categories must equal total expense from the statement of activities. All expense must be accounted for. A statement of functional expense is shown on the next slide. The statement of activities, or a note thereto, reports expenses by functional classification, such as program and administration supporting. Normally, this is a separate schedule. What this means is that you must show the breakdown of expenses between program and administration. For example, the local Salvation Army post runs a soup kitchen, a daycare, and a homeless shelter. In their financial statements, they would most likely have a separate schedule or a footnote to the financial statements that shows expense broken down into soup kitchen, daycare, homeless shelter, and administration. The total of these four categories must equal total expense from the statement of activities. All expense must be accounted for. Here are a couple of additional points related to the financial statements of nonprofit organizations. The statement of cash flows shall be similar in format to that of a business enterprise. Nonprofit organizations must recognize depreciation. Educational institutions record tuition revenue at the gross amount billed and show revenue net of scholarships and financial aid in the statement of activities. And fundraising expense must be accounted for as an expense in the period that it is incurred. It cannot be deferred.